Financial ratios related to solvency, profitability, and market valuation provide important insight into a company's long-term financial stability and shareholder value creation. The program explains that these ratios help analysts evaluate the sustainability of earnings, effectiveness of capital structure decisions, and the market's assessment of future performance. Unlike liquidity and activity ratios that focus primarily on short-term operations, solvency and valuation measures assess broader financial risk and long-term investment attractiveness. Analysts use these ratios together to determine whether a company generates sufficient profits relative to its risk profile and whether its market valuation reflects underlying financial performance. Effective ratio analysis supports informed investment, lending, and strategic decision-making within competitive capital markets. Solvency ratios measure the extent to which a company relies on debt financing and its ability to meet long-term obligations. Important solvency measures include the debt-to-equity ratio, debt ratio, financial leverage ratio, and interest coverage ratio. The debt-to-equity ratio compares total debt with shareholders' equity and indicates the degree of financial leverage used by the company. Higher leverage may increase shareholder returns during favorable economic conditions but also raises financial risk during downturns. The interest coverage ratio measures the company's ability to meet interest payments using operating earnings. Analysts examine solvency ratios carefully because excessive leverage may reduce financial flexibility, increase bankruptcy risk, and weaken long-term sustainability during periods of economic stress or declining profitability. Profitability ratios evaluate a company's ability to generate earnings relative to sales, assets, or shareholder capital. Common measures include operating profit margin, net profit margin, return on assets, ROA, and return on equity, ROE. Operating margin measures the percentage of revenue remaining after operating expenses, while net profit margin reflects overall profitability after all expenses and taxes. ROA evaluates how efficiently management uses total assets to generate profits, and ROE measures returns earned for shareholders. The program emphasizes that profitability analysis helps assess operational efficiency, pricing power, cost management, and competitive position. Analysts compare profitability ratios across companies and over time to evaluate earnings sustainability and identify improving or deteriorating business performance trends. DuPont analysis is an important framework used to break down return on equity into key performance drivers. The program explains that the DuPont model separates ROE into profit margin, asset turnover, and financial leverage components. This decomposition helps analysts determine whether changes in shareholder returns result from operational efficiency, asset utilization, or increased leverage. For example, rising ROE driven primarily by increasing debt may indicate greater financial risk rather than stronger operational performance. DuPont analysis therefore improves understanding of how management decisions affect profitability and shareholder value. Analysts frequently use this framework to compare firms within industries and evaluate the sustainability of earnings and capital structure strategies over time. Market valuation ratios compare a company's market price with accounting measures such as earnings, book value, or cash flow. Common valuation measures include the price-to-earnings ratio, price-to-book ratio, and dividend yield. These ratios help analysts assess investor expectations regarding future growth, profitability, and risk. Higher valuation multiples may reflect strong expected growth opportunities, superior profitability, or lower perceived risk. However, excessively high valuation ratios may also indicate overvaluation or unrealistic market expectations. Analysts interpret valuation ratios carefully within the context of industry conditions, economic trends, and company-specific performance. Comparing market-based ratios with profitability and solvency measures helps determine whether stock prices reasonably reflect underlying financial fundamentals and future business prospects. Although solvency, profitability, and valuation ratios are highly useful analytical tools, they must be interpreted carefully and within broader business contexts. Differences in accounting standards, industry structures, capital intensity, and economic cycles may significantly affect ratio comparability across firms. Ratios based solely on historical financial information may also fail to capture strategic changes, innovation potential, or evolving competitive conditions. The program emphasizes that ratio analysis should be integrated with qualitative assessment of management quality, industry trends, corporate strategy, and macroeconomic factors. A comprehensive understanding of financial ratios enables analysts to evaluate long-term financial health more accurately, identify emerging risks, and make more informed investment, credit, and valuation decisions in global financial markets.